Hello, everyone. Welcome to another edition of Under the Macroscope, Skybound Capital's podcast series. And great to be talking once again to Skybound Capital's chief strategist based out of the London office, Jabir Sadawala. Jabir, it's been quite a while and some pretty important things to catch up on. Can we start with the most recent one? We've spoken about interest rates and inflation a lot on the podcast series, particularly with you. And coming off the back of another interest rate hike last week by the Fed, first of all, was it expected? Was the quantum of it expected? And where does it leave us right now?
Yeah, I don't think there was any surprise about the quantum. It was expected. The issue was always going to be around the wording and what it might imply for December's rate hike, if any, which almost certainly there will be. I think the amount of 75 basis points to take it up to a range of close to, well, call it 3.75% to 4%, which is what they've stated, is, that was very much priced into the market. There was a hint, a suggestion, or so the analyst said, that there would be a softening in its approach come December. I to be honest, I had no view on this. I think I think the wording, which caused a lot of volatility in the market, because initially the idea that we might be approaching the end of big rate hikes meant that asset prices went up and the dollar fell, which is normal. That's a classic sort of risk on sign. But then in the aftermath, and I mean by the close of business the same day, suddenly everything reversed. And why? Because people went through the wording and they felt that actually we're not through it. Now, I wrote about this in last Friday's weekly, and if you look at some of the wording here, the Fed is actually using looser wording around timing. And I don't agree necessarily with everything that the Fed has done, but I can't blame them on this. I mean, all they're saying in a very pragmatic way is that the economy has softened, but we still have modest growth in spending and production. Job gains have been very robust. We saw that with the employment number as well. It was another very good month, and the previous month was revised up quite strongly as well. The labor market is very, very tight. Inflation remains elevated, and that's because it's on fire now from two angles, not just the headline rate, which is coming off a bit as commodity prices have become tempered, but the core components seem to have their own legs, which is quite normal. You get that, you get that lagged effect. So this is from rents, from housing costs, wages, all those things. So they will carry on until such time as we can bring the headline rate down. The Fed made very, very clear that the war in Ukraine is causing, and I quote, tremendous human and economic hardship. The war and related events are creating additional upward pressure on inflation and are weighing on global economic activity. Again, nothing incorrect about that statement. So it remains highly attentive to inflation risks. They are still targeting 2%, but this is where they said or used the words over the longer run, which I take to mean it's just difficult to predict these things. So I tried to sort of paraphrase my own assessment of the whole thing. And, if I was giving a press statement, I would have said something along these lines, that overall the economy is doing well and continues to grow, albeit more slowly. The risks are largely external, but nevertheless serious enough that we need to be mindful of them. With regard to the latter, despite continuing improvements to the supply side, these external risks make inflation targeting unpredictable as they are beyond our control. And as a result, we need to be flexible on timelines in achieving these objectives. So, there's nothing at all unusual about that statement. They're just saying that they are done with the big hikes, which puts them back on the curve before they were behind the curve. And what they do going forward, whether it's another 75 basis points or 50 or 25 or none at all, will be entirely a function of their read on the economy. And it's quite right. It goes on to a wider point, which is that if you look around the globe, central banks are still generally tightening, but we're now seeing to different degrees. And that's because they are trying to keep it in line with their economies, particularly the consumer. That's what it's all about, because there's no point tipping the consumer over the edge. So, yeah, that's it's a long-winded answer to a question.
Jabir, just staying with America before we hop over the Atlantic, closer to home for you. You've spoken here about quantitative factors that the Fed is taking into consideration, and quite rightly has to do so. But there are some qualitative factors that have to be taken into consideration as well, not least these midterm elections. I mean, what's your read on this? Are we seeing an America arguably more divided than we've ever seen before?
Yes, and frankly, that's not. It's not just unique to America. I'm seeing this across the globe. I mean, we have it here in the UK. We have it in across Europe as well. I mean, if you just cast your mind back to the French elections back in May, look how close the National Front came for the first time ever. That doesn't disappear overnight, and I'm sure their support has, if anything, gone up a little bit since then, given the impact of inflation and cost of living crisis. The US election, the midterm elections, which are being held tomorrow, I can only go by the forecasts, and taking some of the renowned forecasters, they are saying that the lower house will now revert to the Republicans, which is quite a shift. And the upper house, their Senate basically, is really, really close to call. It comes down to something like 17 senators, and it's very much in the bag, what happens. But let's just look at it this way. I mean, frankly, even if the lower house does go to the Republicans and the upper house just remains in Democrat hands, that's not good news for Biden. And if both go to the Republicans, that's terrible news for Biden. Then we've got a lame duck president for the remaining 2 years. And just trying to sort of see the drip feed news that comes out of Republican policy, they're making it clear already that they want out of Ukraine. They want to just pull that support. Well, I mean, look, we do know that, and especially if it's spearheaded by Trump, we don't know that for a fact yet. He's got his own issues going on right now. But if that happens, then one thing they do is stick to their policy and their pledges. So, it's going to be a very big sort of dramatic change in events. But that's generally what we're having to live with in the world today, particularly the Western world. Look at Brazil. Look how close that election was, on a knife edge. And it went to Lula in the end. So it swung back just to the left-wing Lula party. That's actually a replay. That was if you take Bolsonaro as a kind of quasi-Trump, and Lula as a quasi-Biden. That's what we've seen there. So this divide, this hairline difference, is proving to be a real gamble now across the Western world and parts of the emerging world. And that just creates for a very precarious situation.
And it's not just divide between parties. If we come across the Atlantic, it's significant divide within parties.
Yeah.
So let's move back to the UK. We haven't chatted since the turmoil that we saw in the Conservative Party in the UK, the fallout of the interim budget announcement, the dramatic loss in value of the pound, the resignation of Liz Truss and her chancellor, the installation of Rishi Sunak as prime minister, and and some quite significant recovery in sterling, but massive instability in the UK economy.
It is. I think the political risk premium that was factored in before, and that was evident in the 10-year gilt yield, that has disappeared. It's now settled down. So there is faith. There is, I think there is some, if not confidence, a level of risk has now been removed. And there is trust in effectively two chancellors running the country now, one past and one present. So the evidence for that was when Sunak then deferred or delayed the budget date to the 17th of November. It was supposed to be, it was originally brought forward to the end of last month. He got away with it quite smoothly. There was no real angst in the market. So within the party, certainly, there are issues. To what extent that actually plays out, we'll see. But I think the press has somewhat over-egged the disunity story. How I see it so far is that Labour obviously still has a big lead in the polls. It's now down to still about 25% or so, between 20 and 25%. So that's massive. It will take time to try and chip away at that, and it will take successful policies. But, don't forget one thing. I mean, there's still 2 years to go till the next election. Boris Johnson had a staggering lead for the first 2 years. I mean, Sir Keir Starmer's future was in the balance. It's only when all this sleaze started to appear that everything reversed. So I think Sir Keir Starmer, if anything, sitting there as opposition leader, must be quite nervous because he's been there, he's seen this, he's lived through it before. But what we do have is some stability. The budget on the 17th has to be an absolute cracker. It's got to be. And I mean a cracker in the sense that it's got to promote growth. And if it does, if the markets feel that this is really good news for growth, then the first evidence will be in the pound, which sunk very low, as you know. I mean, I think it got to about 1.04 or so to the dollar. It's now bounced back in the sort of 111, 112 range, maybe a little bit higher. And even at that price, it's still cheap. It's an absolute bargain. So foreigners are just waiting for a more permanent sign of stability, and then they will charge in. And that could be the big turning event in the pound. In terms of what we've been through with Liz Truss and so on, it was a real shame. It was an absolute shame because I think she and her chancellor at the time had the right idea. They wanted to reduce the tax burden on individuals. What a pity they just didn't seem to understand the way markets work and how all of this needs to be funded. And it's as if they just passed the buck to the Bank of England. Lastly, on this point, I mean, the Bank of England obviously hiked rates 75 basis points last week. I don't think we should be too surprised by that for a couple of reasons. One is in the global context of things, a whole bunch of countries hiked rates 75 basis points in reaction to the Fed. There's this battle for a stronger currency, if you like, because if their currencies get any weaker, they start to import even more inflation, as if they don't, as if they've got, they don't have enough of it already. But the other factor here is that the Bank of England had to make do with the information that it had. And with the budget now delayed till the 17th, they had to premise everything on what they knew in the past. So I think they had nothing to lose in the end. I think they just thought, okay, let's whack it up 75 bips, get it out of the way, and then we'll just sort of see how things go from here. They can remember they don't have to hike in future, or they can do lower hikes. So they're in a stronger position.
Not to conflate issues, but maybe to combine two things that you've spoken about here. You're saying people are waiting for this budget on the 17th of November. It needs to be pro-growth. Presumably, it needs to also address a topic that's been spoken about often in the UK recently, the cost of living crisis, and that largely around energy bills.
Yeah.
And if I bring it back to what you said about the cost of the war in Ukraine and its effect on inflation, that is largely due to energy prices. And with the Northern Hemisphere winter looming,
yeah,
where are we at there in terms of trying to moderate the cost of energy and therefore the general cost of living?
Yeah, well, that's obviously, excuse me, that's the big question, isn't it? Because Putin, no doubt, will be praying and hoping for a severe winter. We might get it. I don't know how, generally I take global warming to mean, from what I've seen of past winters, they've been more tempered. I miss the good old days of a really good, feisty, cold, snow-ridden type of winter. So anything mild is going to be good news for governments, outside of that region. In terms of what's been laid out now, the energy support package is available to everybody, but for 6 months. It was 2 years under Liz Truss and Quarting. So that's now brought down to 6 months. The energy price cap is going to be fixed at £2,500. And then in 6 months' time, it will effectively be means tested, which I take to mean that, low incomes will continue to receive further support. And overall, I think that sounds pretty fair. If it really gets out of kilter, then we're going to need some harsh actions. I mean, it's as simple as that. Look at what Germany's been doing already, just to help refill its gas supplies. And it's done a fantastic job. I mean, kudos to them. They've introduced all kinds of measures, energy saving measures, right down to micro detail in offices. Any floor that is just left open, switch off the radiator and all of that kind of stuff. It's all making a difference. And as a result, they're now almost back to their 90% refill targets. And Europe as a whole, I think, is hit about 85%. So it's got enough to see itself through the winter. And I'm sure that annoyed Putin considerably. I think where we go from here really is going to be obviously a function of the type of winter we have. But secondly, how much resolve people still have to keep supporting the Ukraine war against the Russians. I think that's going to get tested, and that, from Putin's side, is what he's trying to do. He's trying to stoke the fire in order to wear the Western world down. And yeah, beyond that, it's difficult to comment. But I mean, look, if commodity prices keep going up, then we're back to square one again. Then that means headline inflation will start to pick up again. And then it feeds through, and it's just a vicious circle.
And given that circle, given all the inputs to, if we can call it, the global economy at the moment, just finally, what economy or country do you think is best positioned for growth coming out of this period?
I think every time I look at what's going on around the globe, the US is still the one country that offers some sort of growth, albeit much more moderated. And I think therefore it's evident in the valuation of US stocks. At the last count, the forward PE ratios just for the MSCI US index was trading at around 16 and a half times, which is not. It's not devastatingly high, but it's on the high side. But it's interesting that is the one standout country in terms of valuations. When you start to look outside of that region, they drop dramatically. You've got they come down to as low as 10 times. So the rest of the world is very cheap. But the thing is, they've got risk premium built into it. So I think in terms of quality of growth still, I would still want to go there. Naturally, keep an eye on earnings, because earnings, you're seeing warnings ahead, and that is a worrying sign. But for now, I'm still drawn to the US and possibly one or two highly select emerging markets.
Well, let me tell you what I'm drawn to. And hopefully this will bring a smile to your face around a mild Northern Hemisphere winter. I'm conducting this podcast from the south of France, and it's so beautiful here. I might actually just go for a dip in the sea.
Great. Well,
I won't send photos.
No.
Javier, as always, great to get your views. And we live in very uncertain but dynamic times, and things are ever changing. You talk about the lead in the polls for Labour in the UK. I think we can quite confidently say at the moment that even 2 weeks is a long time in global politics.
Yeah, it is.
Well, thank you again to Javier, and thank you to you who have listened in to the podcast. You can download Under the Macroscope at Apple, Spotify, and the Google podcast platform for Android, and also on our YouTube channel with all past editions of Under the Macroscope available at our website, which is skyboundcapital.com. Until next time on Under the Macroscope, have a great day.